Good evening. This is Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting. As we speak, Treasury Consulting is a multi-asset and multinational hedge fund. By multi-asset, I mean we actively take positions in multiple asset classes like gold, silver, platinum, palladium, base metals, oil, natural gas, equities, foreign exchange traded derivatives, contract for differences, and respective. God willing, we would be adding more asset classes in near term. By multinational, I mean to say we actively covering asset classes at multiple locations across the globe, which includes United States, European Union, and Asia Pacific region. But like I repeated many a times, and I would continue to repeat all the times, that we are a proprietary hedge fund. By proprietary, I mean to say no third party. Let me repeat, no third party can invest capital in our funds. Treasury Consulting and none of the subsidiaries of Treasury Consulting is taking funding from any third party. Please take a note of that. Banking is the most PR managed business we have in the world. I worked in banking and I'm completely aware about that. It is an industry which is PR managed. You will see the interviews of the CEOs. You will see the advertisements by bank on the business platforms like Bloomberg. You will see the fancy predictions by the banks and the hype like Goldman said about the Bitcoin. Very recently, Morgan Stanley talked about Indian Sensex, Citibank, JP Morgan covering the loss-making startups. And all of these things will get hype. There are selected PR firms we have in the world. Those are designed or actually capable to promote anything. This in technical parlance known as upstairs market. So what I'm talking is part and parcel of upstairs market. But unfortunately, many people in the world do not even heard that there is something known as upstairs market. Today, I would like to cover yet another thing which is happening in the world of investment banking. And I downloaded this from one of the Middle East websites of the world. Now, this document which I downloaded, and I'm showing this document to you, this document is nothing but a document which talking about the investment banking slump. But before I move forward, let me first tell you a brief background. I was in my MBA 2005-2007, and I still remember when UBS, Credit Suisse, all these financial institutions, rather European investment banks, were having hub of investment banking. I correctly remember that in 2005 to 7, there was a boom in the investment banking. And the boom was at that level that everyone at that point of time was pursuing CFA. I remember even my teachers used to uh, push me that you should have gone for CFA rather than going for MBA, because CFA having a good career prospects than MBA. But I was adamant that I never wanted to be an investment banker. I strongly feel that the knowledge level of investment bankers are not at excellent or at par with the merchant bankers. Because merchant bankers are those bankers who actively take positions, rather who actively work in multiple market. More importantly, they cover their clients on daily basis. While investment bankers' roles are over once the funds are raised. The time funds are raised, their role responsibility is more or less over, except a catch like the safety net, which means they are forced to lock in for a respective period of time. This is the only thing they are doing. Because when it comes to the trading, when it comes to hedging, when it comes to the P&L, everything is taken care by the proprietary either or the front office desk of that bank. The role of merchant banker is done as soon as the funds reach the P&L of your client. Simple. The role is done. Henceforth, investment banker, I always feel that merchant banking role is one of the most competent role as far as the banking is concerned. But unfortunately, if you see Google, internet, or probably the courses which people launched, there is hardly any talk about the merchant banking. I don't want to name any specific countries, but there are many countries we have in the globe where merchant banking is highly restricted, where the attitude of the central bank is so timid that they do not want it to open the merchant banking industry for the youngsters, for the new corporates, for the new banks. And result, the nation never grew. The nation never grew. Merchant banks or merchant bankers never be hire and fire, because they knew that their business is stable, more or less. But I'm not saying that they are not immune to the depression. I'm never saying that they are immune to depression. But having said that, merchant banking is a unit where the beta means if the market is in depression, till what extent you are impacted, where the beta is limited. While investment banking is an industry where beta is extremely high. And unfortunately, now in 2022, you can say we are just 15 days away from 2023. And like I said very clearly in my videos, that 2023 would be as volatile as you never expected. 2023 would be more volatile, more unpredictable, that would be the right word, as compared to 2022. The people who are carrying the heavy luggages, people who are carrying huge portfolios, they should be very careful about 2023. Rest, when the time would come, you automatically get to know. And 2023 won't be a good year for investment bankers. And the signals are already in the public. Now, the figures, the facts, the names which I am quoting is not mine. It is there in a public document. This document is not a confidential document, something which is only accessed by the CEOs of big bank. This is a public document. I download it from internet like I always do my research and all. But unfortunately, people do not pay much attention to the internet. They believe that whatever is coming in media is the only thing we are having. But I always ignore media, especially Bloomberg, and I always focus on the documents which I have on the internet because they hold more value, they hold more knowledge as compared I'm having on the media. Best, I would pick up. We need to understand that investment banking business in the world is more or less controlled by the top 5, 7 banks of the world. More or less, you can say. Maximum 8 or 9 banks in the world. It is not that other banks do not have that investment banking business, but majority of that business is held by the top banks. Rather, the best word would be the cream deals, like the top deals, the money making deals. They all are controlled by the top banks. There are tactical reasons behind that. We cannot discuss these tactical reasons, or it is not that the lower and banks do not have a competence of that. It is not like that. They do have competence of that, but unfortunately, banking is a world where we still believe that the bigger is better. Unfortunately, we believe that the bigger is better, but the hard reality is the bigger is not better. Unfortunately, the hard reality is the bigger is not better. In this regards, we need to understand that when it comes to investment banking, the movement of the industry, I repeat, the movement of the industry is seen from the top 5, 7 investment banks. If they are hiring, it means the industry is hiring. If they are firing, it means the industry is firing. It's a common sense. And unfortunately, we cannot run away from this fact. According to the public information, the top 5 US banks, I repeat, the top 5 US banks' revenue in the investment banking fell 47%. Congratulations. 47% in the last 9 months. The top 5 investment banks' revenue fell 47% in the last 9 months, which, by the way, is a huge number to me. Probably it might not be a huge number for many people, but it's a huge number to me. It means this figure is as of September 2022, 9 months. October, November, December is yet to come. And the kind of global economy we are facing, Adobe, Cisco, Intel, Amazon, Microsoft, Google, Facebook, you name the big names, the profitable companies, the well-established business models, they all are cutting jobs. All are cutting jobs. Adobe, one of the most profitable software companies in the world, If anyone is not aware about Adobe, then I'm very sorry for him or her. And today I'm getting an information that Adobe is cutting 100 jobs. So if in the first 9 months, the revenue in the investment banking is fell by 47%, then you can expect the last 3 months it would also be negative. It's a common sense. And we cannot run away from this fact. But unfortunately, the data and the statistics I have is more glaring what you never expect of. The data and statistics I have is more glaring what you never expect of. According to the public information, JP Morgan Chase, Bank of America, Citibank, all are waiting plans to cut bonus pools for their investment bankers as much as 30%. As much as 30%, according to the people with the knowledge of internal deliberations. Some firms are planning to give low performers no reward and all, which means if you not performed as per the standards or the targets set up by the relevant investment bank, you will not get any reward. The proposals are still underway and could change in the coming months, such as early snapshot of the industry year-end bonuses after corporate deal-making and sales of new securities waned among 2022 market soon. Do you know that in the first 9 months, the revenue of top 5 investment banks fell 18.8 billion. 18.8 billion, which is precisely 19 billion. And this is the top 5 investment banks of United States. We do not have any statistics of European investment bankers. We do not have any statistics for Japanese investment bankers. Asian investment bankers, just like you have Singapore, Dubai, and Hong Kong, we don't have any information. But there is a logic in the life which is called common sense. Unfortunately, people do not borrow this logic, but I do. This logic clearly suggests that if the top 5 investment banks only in US ends up 19 billion US dollars worth of fall in their revenue, then common sense is the global investment banker industry would have more than 100 billion. It's a common sense, fair common sense. Wait for some time, probably a couple of months. You will have this information also in the public. And the statistics which I'm going to be following is more glaring. Because of 19 billion fall in the revenue, it would end up more fall, which is called trading income. You would be surprising that this is not mentioned in the article. Then why I'm referring this? Suppose any investment banks got 600 million or probably $1 billion from a deals in a 1 year. Suppose, assuming any investment bank. What they do with this money? Would they simply deposit this money in the banks? Term deposits? Mutual funds? No, they don't do that. They make money from money, which is a right attitude in the life. They make money from money. And how do they do? The prop desk. Prop means proprietary. Sometimes it's a market making also. I already uploaded a video about market making on our YouTube channel. The prop desk trade this money, trade the securities using this money, and make more money, which is a collective, I would say, is a collective part of FICC. Now, what the hell is FICC? Fixed Income Currencies and Commodities. American and European banks are valued at FICC, which is Fixed Income Currencies and Commodities. While in India, there is no FICC. It is only net profit. Because our banking system is living in 1947 ages. There is hardly a single bank in India who reports FICC, ROTA, Return on Tangible Equity, ROTA, Return on Tangible Assets, and all these benchmarks. While American banking industry, in their annual report called 10K, share this information in public. But unfortunately, we do not. Since this almost 19 billion worth of losses fall in revenue, would definitely ends up losing more revenue, which is called FICC for banks. More importantly, it would end up losing the bonus pool also. In this third part, I would be covering what is bonus pool and how it would get impacted because of fall in revenue. Bonus pool is nothing but a pool, rather I would say a part of PAT. What is PAT? Profit after tax. In our parlance, it is known as bottom line. Bonus pool is a pool which is maintained by the investment banks. They have a forecast. Forecast means this much quantity or the quantum of the deal they are expecting in this year. 10 billion, 20 billion, 30 billion, 40 billion, 50 billion, 100 billion, or whatever they are expecting in this year. And they knew that the kind of deals they are expecting, the expected margin they would be getting. That margin might be 15%, 20%, probably 30%. You would be very surprised that I mentioned 20% and 30%. Don't be surprised. Investment banking industry do not work on thin margins. You heard me very right. On paper, it is shown that they're working 1% fee, 1.5% fee, in some cases 0.25% fee, but the reality, they work on a very hefty margin. They have inbuilt payment structures. I repeat, inbuilt payment structures. People do not know that. The courses like CFA, Certified Financial Analyst, you heard me very right. The courses like CFA, Certified Financial Analyst, they do not teach this. So the margins of investment banking industry is huge. And these huge margins can only be possible provided you get deals. You know, guys, the top investment bankers of the globe, they are getting millions as bonuses. They're not getting few hundred thousands as bonuses, millions as bonuses. Company driven vehicle, company driven company home, uh, vacations, business class travel, 7-star accommodations, and you can't even assume what they are getting actually. From where this money is coming? This money is coming from the profit margins they are maintaining in investment banking deals. But unfortunately, in public domain, it is demonstrated, that would be the better word, it is demonstrated that the investment banks work on low margin. If I go with this document at Bank of America and Citibank, I love Citibank. I love three banks: JP Morgan, Citibank, and Credit Suisse. They are my favorite banks. Why? There is hardly any scandal which is left by them. And I'm waiting for the day when the global regulators like Federal Reserve, Securities and Exchange Commission. In UK, we have FRC, we have FCA, Financial Conduct Authorities, and we have different regulators across the globe. I'm waiting when the global regulators will revoke the license of these banks, which I doubt would happen in my lifetime. Today I am 38, and I don't think even if I live till 98, it would happen. The reason being, we are living in an era of corrupt regulatory practices. But anyways, at Bank of America and Citibank, that means that executives may hold bonus pools for traders around last year levels. And executives at those banks are discussing rewarding top commodities and rate traders. Because we have seen there is enough volatility in the rate market. Rate market is a market which deals in interest rate trading. It includes IRS. That's more important. IRS stands at interest rate swap. 99% people do not have any understanding of interest rate trading, also known as rate trading. But probably in the later stages, I would introduce you some dynamics of the rate trading also. This year, banks like Citibank, Bank of America, Barclays are considering giving dozens of their lowest performance no bonus at all. Congratulations. I'm telling you one thing, guys, it's not a question of the bonus. It is a question of job cuts. I'm again telling you on record that banking is an industry where if on paper you see a job cut of 100 people, assuming the actual job cut is 500 people. Because you will never get to know about the right quantum of the job cuts in any bank. The global banking system is designed in such a way that you will never get to know. Just like even today, if you open internet and see that JP Morgan Chase cuts hundreds of people from their mortgage division. This is not the latest information. This information is around 7 to 8 months ago. But this hundreds would never come in public. 200, 300, 400, 500 1,000, 2,000, 3,000, it would never come in public. The reason being, banks are designed accordingly. To cut the long discussion, like I told you, that the variability, the predictability, the volatility would continue to rise. And I'm assuring you one thing. Sooner or later, you will see a huge mess up to build in the investment banking sector. By mess up, I mean to say you will even see a huge job cuts in the banking sector. And that I'm warning you. I'm already telling you that 2023 and 24 won't be good years for financial industry. It won't be easy. It won't be easy for even the top banks to stay in the game. The people who are carrying heavy luggages, by heavy luggages I mean huge portfolios, they should be very careful. And these documents are an evidentiary value. Evidentiary value in law means that these documents are giving you a glaring picture. A picture which we cannot ignore. Yeah, we may try to ignore this, but we cannot ignore that. And another thing I would like to let you know, though I would be having a separate video in this regard, which is the people who are not competent, who are not excellent skill set in banking, because everyone in the banking is not as competent as the top bankers are. That's also a fact. So the people, those who are not competent, the people, those who are not technically very strong, the people, those who are working in the back offices, the people, those who are working in the middle offices, they need to be very careful. Because when the banks lose their revenue, they lose their profitability, they become the first and the easiest target for banks. Because they can easily be replaced by any computer algorithm, easily be replaced by any automated bot, or probably at low cost employees. You need to be very careful. You need to upgrade your knowledge. You need to be increase your competence. You need to focus on your competence. You need to learn the new regulatory frameworks, the new P&L things, which is like FRTB, Fundamental Review of Trading Book, and so on and so forth, as to stay in the picture. Please don't assume that whatever you learn from your degrees, from your certifications is enough. Banking is changing almost every possible day. So please continue to upgrade yourself. That's my humble request. I'm not getting anything once you upgrade yourself. This is only for your benefit. Rest all your goals. But yes, I strongly see that 2023 won't be a good year for banking industry. I continue to stress that we will see the job cuts. And when I use the word job cuts, means worldwide. I'm not restricting myself to any specific country or any specific bank. But yes, if the top banks fell, common sense, the people who are at the lower end, they have more pressure. It's a common sense. This is Rahul Magan from Trishi Consulting Group. You knew my personal number +91 9899 242 978. Let me repeat, +91 9899 242 978. Alternatively, if you wish to have more information, you can visit our fixed income platform www.fixedincome.global. Let me repeat, www.fixedincome.global. Please do understand that if you are in a world of banking, please continue to upgrade yourself. Please do not be dependent on a relevant degree or a certification. Continue to upgrade yourself. This is the only way. I repeat, this is the only way which can save you in this volatile market and in this volatile sector. Knowledge is the key. This is what I can say. God bless you guys. Please be ready for 2023. I'm definitely with you. I would continue to upload videos. I will continue to guide you. As always, in case you have any relevant question, I repeat, any relevant question, you can WhatsApp me or you can give me a call. Thank you, ladies and gentlemen. Have a good time ahead.